The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business.
What's up, guys, and welcome back to the channel. This video is part one of a 4-part course where I show you the methods and philosophies that the best investors use to beat the market every year. It's no secret that Warren Buffett, Charlie Munger, Phil Town and Mohnish Pabrai have all compounded money at a higher rate of return than the general market for over 20 years. In Warren and Charlie's case, it's over 60 years. So the question is, can we do what they do and beat the market ourselves? Or are we better off passive investing in the general market and not trying to pick our own stocks? Well, the answer to that is yes, you can beat the market. Most of the people I named believe that the average person can beat the market, but only if they learn the methods I'm going to be covering in this series and they have the correct psychology to be a long-term investor.
So the idea that you can't beat the market is nonsense being taught to you by people who don't even want to try. They just want to diversify. They're sales guys. They don't know how to beat the market. So let's just go for a simple plan here maybe. Because the people who do beat the market do have a simple plan. It's a simple proven path that you go down with discipline and patience once you learn how to do it. And you too can have the same kind of rewards. It's not rocket science. It's not a high IQ. It's just learning how to properly invest and then applying it with discipline and patience. You can do this. Don't fall for the lie that you can't beat the market.
Now, the framework we're going to be studying is something that I found the majority of the best investors who beat the market all use, each with their own little tweaks and differences. If you watch my How to Pick Stocks video, you'll already be a little bit familiar with this framework. But in this series, we're going to be going into way more detail and I'll be explaining all the different terminology that you'll see along the way. Throughout this series, I'll also be showing you guys lectures, interviews and book extracts from the best investors that we're going to be studying from. Now, I get asked a lot, what stocks should I buy or what companies do you recommend? I'll always be completely transparent with my portfolio and what stocks I own, but I can't ever tell you what stocks you should own. And it wouldn't serve you well even if I did. What I can do though is teach you how I learned to pick my own stocks using what the best investors teach in their books and in their interviews. Methods that help them beat the market and has worked really well for me so far. So a more accurate title for this series would be I'm going to show you how Warren Buffett, Charlie Munger, Mohnish Pabrai and Phil Town all invest. And I've found they all use the exact same framework for their investing, which is broken into 4 key parts. Now, the framework we used in my How to Pick Stocks video was taken from Charlie Munger and Warren Buffett, which is understand the business, does it have a competitive advantage, analyze the management team, and finally valuation. But in this series we're going to be using the framework outlined in Phil Town's book Rule 1, which is the exact same as Munger and Buffett's, but it's just explained slightly differently. So if you want to learn from the master, I highly recommend this book. So Phil Town's framework is known as the 4 M's, which stands for meaning, moat, management and margin of safety. Like I said, pretty much all of the great investors use the same framework, but each have their own style when it comes to execution. And hopefully by the end of this series, you'll be able to begin exploring and finding your own style as well. Now, before we get into the first M, we should discuss what this Rule 1 is that he's referring to. The number 1 rule of investing as stated by Warren Buffett is don't lose money. And rule number 2 is do not forget rule number 1. Now, according to Phil Town, what this means in practical terms is to invest with certainty, which comes from buying a wonderful business at an attractive price, and that's it. And then we use the 4 M's to figure out if it's a wonderful business and if it's at an attractive price. Simple, right? So let's spend the rest of this video talking about the first M, which is meaning. The first part of knowing if a business is wonderful is if that business has meaning to you. Phil Town says you want to pretend that this business will be the only business that you will own to support your family for the next 100 years. When you buy a stock, it's not just a piece of paper. It's a part ownership of the company. A trait all the best investors have when they buy stocks is they pretend that they bought the entire business, even if they just bought 1% of it. So think like a business owner, not an investor. So if you're buying an entire business and you're acting like it's the only business you will ever own, then it makes sense that you'll think very carefully about what businesses to own. If you're looking at buying a business, ask yourself these 2 questions. Do you want to own the whole business? And do you know enough about the business to buy the whole lot of it? If we want to invest with certainty and own businesses that are wonderful and will prosper well into the future, then we really need to understand that business. When it comes to understanding the business, you don't need to know every last detail of the company's operations. You just have to have a basic understanding of how the company works and the industry that it operates in. For example, I'm a gamer and I have been since I was 10 years old. When I was younger I started off playing Xbox, and then as I got older I moved to playing on PC. And then later on I started building my own PCs. So off the top of my head, the companies that I'm capable of understanding just based on one hobby is Nvidia, AMD, Intel, Corsair, Microsoft, Sony, and many others. So if you apply that to your hobbies, your interests, or your career, you'll be able to come up with a list of companies that you already understand at a basic level. Peter Lynch's most famous quote is to buy what you know.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
Phil Town says if we don't understand it, then there's no possible way that we can say for certainty that this business will prosper well into the future. For example, right now, a lot of people are talking about the cybersecurity industry doing really well in the near-term future and the long-term future. But I do not know a thing about the cybersecurity industry. So if I'm looking at businesses in that industry, I have no idea which businesses out of a list will do well in the future. I might as well throw a dart at a dartboard at a bunch of random company names because that's as much as I know about those companies. So it's important to create a circle of competence and never stray outside that circle. Over the years, you can learn new things and you can make your circle bigger. But just as a rule of thumb, never invest outside your circle of competence and invest in companies that you don't understand. Phil has an exercise in his book where you can find a bunch of companies or industries that you understand by using an exercise called the 3 circles, which was created by Jim Collins. I'm going to tweak it somewhat just to make it easier for you guys to read it on screen, but the idea is the exact same. Essentially, you draw 3 circles that intertwine. One labelled passion, one labelled talent, and one labelled money. In the first circle, write down everything you're passionate about. The things that you would do if you had the time or the money. In the talent circle, write down everything you're good at, either in a professional or a recreational sense. And in the third circle, write down everything you make money on and what you spend money on. So if I fill this out for myself, in the passion circle I would have gaming, investing, making YouTube videos, streaming, reading, and sustainability. In the talented circle, I'd say I'm good at gaming, at least I think I am, building PCs, editing, researching, and in the last circle where I make and spend my money, I'd have driving for Uber, Menulog, and DoorDash, building PCs, food, books, editing software, entertainment, and games. So the idea is that now you can make a list of companies that have meaning to you and that you understand. So if you drew the circles again, but this time you write down the companies or sectors that fall into that circle. So for me, in my passion circle, I have AMD, Corsair, EA, Blizzard, and pretty much any other company in the gaming sector. Companies like Adobe that make editing software for making YouTube videos, YouTube itself, which is owned by Google, and then companies like Tesla that provide sustainable products or services that I would use. If I could and had the money, I'd have 3 Teslas, a solar roof, and a Powerwall battery pack. In the talent circle, I'd have again gaming companies, whether companies that make the games itself or the hardware to play the games on, and companies that make editing software like Adobe. And where I make and spend my money, I'd have Uber, Menulog, DoorDash, AMD, Corsair, and Intel for my money in, and money out would be Amazon Twice for buying books and Amazon Prime, Netflix, Menulog and Kohl's for food, and for games EA, Tencent, Nvidia, and AMD. So now I have a list of companies that I'm capable of understanding. Phil Town goes further and says that before we can check off the first M, we must remember that if we're owning a whole business, then we must be proud to own it. Because if you're buying a company, you support that company's direction and you want it to prosper and continue well into the future. Everybody has their own set of values, and it's important to really think about that when you're looking at companies to buy. I would never want to own a company if I find how they operate distasteful. So if it's a business you understand, you'd own the whole thing if you could, and you'd be proud to own it for a long time, then you've made it past the first M, and you're ready to move on and keep digging. So let's quickly recap what we've learned in this video. The average person can beat the market over the long term. All of the best investors use virtually the exact same framework to beat the market. We beat the market by buying wonderful businesses when they're at an attractive price or they're on sale. We use the 4 M's to find out if the business is wonderful and if it's on sale. We learned the number one rule of investing, which is don't lose money or invest with certainty. And finally, we looked at the first M, which is meaning, which requires us to think like business owners and act as if we're buying the entire business when we invest, which means the business needs to have meaning to us, we understand it, and we'd be proud to own it for a long time. The last point I want to make about meaning is something taken from Peter Lynch, and that is spend as much time shopping for investments like you do when you're shopping for a new car or a holiday. If you're a good shopper in real life and you hate paying full price for goods, you constantly shop around for deals. So if you're a great shopper, you already have the perfect personality to be a great Rule 1 investor. It's the exact same mentality required to be a successful investor. Always look for deals and never pay too much for something, even if you really want it. And you do that by knowing what something is worth, which we'll cover later on in the series. In the next video, we'll be looking at the second M, which is moat. So what gives a business protection against attackers and competitors who are trying to steal their profits, and the numbers to look at to know if the business does have a moat. If you guys have watched the video all the way to the end, thank you so much for watching. I really hope you guys found this video useful, and this series helps you to start your own investing journeys and show you that you can pick your own stocks and you can beat the market. I've had some people say that I should make a paid course, but I don't really feel like it's right to sell this information to you because it's not even mine to begin with. The entire framework and philosophies are taken from the best investors in the world, and I'm just a messenger sharing their ideas and wisdom with you guys. If you guys did enjoy the video and you want to support me, all that I ask is that you please hit that like button. And if you want to see more videos like this one or get notified when the rest of the course comes out, then hit that subscribe button, tap the little bell there, and you'll get a notification whenever I release future videos. And as always, if you guys have any questions, please let me know in the comments down below. I reply to every single question. As always, this video is not financial advice. That's it for this video. Thank you so much for watching, and I'll see you guys back in part 2 of the series.